I've been asked by one of my subscribers to start doing periodic commentary type videos to cover current and recent events instead of discussing mainly my theories about money, debt, and gold. I'll give it a shot and see how it works out. You all need to give me some feedback and let me know how useful this is to you, or if I should just stick to what I'm good at. The topic that seems to be of the most importance at the moment is the recent rapid decline in oil prices. In a matter of only a few months, we have seen oil prices drop by more than 40%. A decline like this we haven't seen since the 2008-2009 financial crisis. And I'm personally very concerned about this, not because of the tight historical relationship between gold and oil prices, but because of what I know about large industrial capital projects. For those of you who don't know, I'm a chemical engineer by trade, managing a large research and development group in the chemicals industry. So I know how the system works from the inside. I've also seen how employees and executives will hype the latest stories to further their own careers and increase the company's stock price, only to find years later that the assumptions made were critically flawed. Let's look a little bit at how recent price action in oil has led to one of these cycles of hype. Notice on the oil price chart here the steady climb in the price of oil starting in the early 2000s. In 2007, the price of West Texas Intermediate oil exceeded $60 per barrel. It kept going beyond that and reached the mid-100s before the economic crisis of 2008-2009 caused the price to crash back down to earth. It bounced back as a result of a magical government money pump being turned on, and it climbed past the $80 per barrel mark in 2010 and has stayed above $80 per barrel since that time. In fact, from 2011 to 2014, the price has hovered around $100 per barrel. And what was the impact on the hype cycle? Well, in the news, we started hearing about the fracking miracle. We started to hear that the United States was going to become the new Saudi Arabia. In my own company, I started seeing countless proposals for how we could participate in this new and permanent industrial trend. The stories that were told were sublime, and the assumptions that were made were just short of absurd. We can see how price dictated story by looking at Google Trends. Here, I typed in the word fracking to see what the result would be. Notice the large exponential increase in the search and news story frequency for the word. Once we passed 2010, the technology that almost nobody was aware of became a common household word. Everyone was talking about it. Everyone was thinking about ways of investing in it and hopefully getting rich as a result. And they acted on their dreams, in a big way. To understand the seriousness of the problem, let's consider the size of the US and Canadian energy sector. From 2011 to 2014, capital investment in the oil and gas industry was about $400 billion per year. For those of you who are not familiar with the term capital, it generally means an investment in new plant or equipment that is expected to remain in use for a number of years. A capital expense could be the purchase of a building, the purchase of an oil rig, a significant upgrade to a refinery catalytic cracker, or what have you. The key is that when a company spends capital, it's an irreversible decision. The company parts with cash, typically borrowed cash, and takes possession of productive equipment that the company then needs to use to generate a profit. Capital spending is generally the source of job creation. After all, when you have a new piece of equipment, you also need people to operate it. Plus, jobs are generally created in other industries as well. For example, someone needs to fabricate the equipment, someone needs to make the steel from which it's made, someone needs to make the food to feed the workers in the field, someone needs to build the houses where the workers will live. You get the picture. Now, let's try to understand the magnitude of $400 billion in spending in a given year. In the US in recent years, total capital spending in all industries was about $1.2 trillion per year. So we can see the capital spending in the energy sector represents a large portion of the total. If we subtract out the $80 billion a year spent in Canada on oil and gas, we're left with about $320 billion worth of oil and gas capital in the US. Thus, capital spending on energy infrastructure in the US is about 1/4 of the total. This is hardly insignificant, especially when one considers how new spending in this sector can lead to spending in all of the other sectors which provide the steel, the housing, the food, etc. If fracking only started becoming a common term in the US households when the price of oil exceeded $80 per barrel in 2010, Do we need to be concerned now that the price of oil is back to $60 per barrel? Let's discuss further the nature of capital investment. Unfortunately, because capital spending generally involves borrowing, we need to also discuss interest rates. So pardon me while I make my chart a little bit more complicated. I placed the trend of T-bill rates on this graph because it's simply interest rate data that I already have on my hard drive. Long-term corporate bonds will generally follow the trend in T-bill rates, but be a few percentage points higher due to duration and potential default risk. No matter. It's the trend that I want to put here just for the sake of the discussion. Note that at the same time that oil prices were rocketing past $80 per barrel, interest rates were crashing down to historic lows. From 2010 to 2014, we had a combination of very, very high oil prices and very, very low interest rates. That's all we really need to keep in mind for the discussion that follows. High oil prices and low interest rates. So why is this important? Well, think about it from the standpoint of a corporate executive who has to make a decision about whether or not to invest in a large project. There are lots of factors which will be considered, but ultimately the decision usually boils down to a few simple things. How much money the project will generate in the future, what portion of the money will need to be given up to fund continuous operations and maintenance, and how much money we will need right now to buy the facilities and equipment. The first of these is the stream of revenues, the second is known as the operating expense, and the last is known as the capital expense. Most of the time, there's not a big pot of money sitting around waiting to be invested. Executives don't like to keep idle cash sitting around. For this reason, most of the money to fund capital projects is borrowed, and so a fourth factor comes into play, and that is known internally simply as the company's cost of capital. This is the interest rate at which the company can borrow money in the bond market. If some of this is unclear, don't worry. It will become a little bit clearer in a moment. I'm going to greatly oversimplify things just for the sake of making a point, but I'm sure that the accountants in my audience will forgive me for committing this sin. I'll avoid clouding the picture with depreciation, amortization, and taxes. While important to our captains of industry, these factors will only confuse the general viewer. So let's just keep things simple. Now imagine you are a corporate executive watching a presentation from one of your business development people who is trying to sell you on the merits of a big capital project. He tells you that the price of oil is $100 per barrel, as it was in 2011 to 2014, and a project can generate 100,000 barrels of oil per year for the following 10 years. Then the revenues will be $100 per barrel times 100,000 barrels per year, or $10 million per year. Now suppose it's projected that once all of the necessary capital is in place, it will cost $20 per barrel to process the shale and produce something equivalent to a barrel of oil. This means that 20% of the revenue will go towards operating expenses, which leaves $8 million per year in operating profit. Of course, some of that will disappear due to taxes, but as I said, we're going to keep things as simple as possible. So far, so good. You like what you hear from your business development person. So you ask your business development guy what it will cost to execute the project. He turns the presentation over to his cost estimator, who tells you that when the installation is finished, the total expense is expected to be $50 million. This will include all upstream, pipeline, and downstream investments necessary for the 10-year project. Of course, he warns you that most of the capital will have very little value after 10 years because you won't be able to easily relocate it without doing a lot of work and a lot of refurbishment. But this doesn't bother you much. You see the $8 million of operating profit and consider that in 10 years this will give you $80 million from a $50 million cost. Plus, being a wizard who received his training from the Harvard Business School, you know that you can generate a very, very favorable return by borrowing the money in the bond market and paying the principal back in 10 years' time. And especially now that interest rates are at record lows, your company can borrow the money in the bond market at only 5% interest, whereas in previous years it would have cost you 10%. So you decide to give the nod of approval to the project and borrow $40 million of the needed capital from the bond market. So you sell a 10-year bond that has a 5% interest rate. And there are many investors who are lining up, chomping at the bit to take advantage of this fat yield that only corporate bonds can yield right now, because treasury markets are just so low. The other $10 million you fund internally out of cash. Of course, since you decided to borrow most of the money, your expenses have gone up. You now have a $2 million per year expense as a result of operating costs per barrel, plus an interest expense of another $2 million per year, leaving you with $6 million per year as your profit. You also have to worry about returning the $40 million that you borrowed at the end of 10 years. But no worry. Because the company only parted with $10 million of its own cash, you calculate that the rate of return on this project will be about 57% per year. All you need to do is carefully manage your cash flows so that the $40 million bond that you borrowed can be paid off in year 10. No problem. By now I'm sure that your head is spinning a little bit. Can you see why I decided to leave out a few details? But let's get back to the example. You make the $50 million investment and you are totally committed now. You can't unspend the money. But you have a strong belief that you just made your company millions of dollars. And you've promoted that to your board of directors and to your shareholders. But then something unexpected happens. So many people have invested in projects like these that there is now more oil to sell than there is demand for it, and the bottom drops out of the market. You now find yourself with $60 per barrel oil. What happens now? Well, your revenue now drops down to $6 million per year. You still have the same operating cost of $2 million per year, and the interest expense of $2 million per year. So the cash flow you're getting from your operations is now only $2 million per year. Do you still operate? Of course you do. If you don't, you can save yourself the $2 million in variable costs, but you still have the $2 million in interest expenses that you have no option but to pay. And you need the oil revenue in order to do that. But if you operate, you can at least get $2 million per year in positive cash flows. Would you invest in a new project like this one at current prices? No way. But that's the problem with time. It only goes in one direction, and you've already made your choice to invest the money. But can you identify the big problem that you're now facing? Give it a few seconds and think about it. If you recognized that you still have a big $40 million obligation to bondholders in 10 years' time, you're absolutely right. That is the big problem. There is no way that you're going to be able to pay it unless oil prices recover. At current prices, over 10 years, your positive cash flow will be $60 million, and your negative cash flow will be $90 million. You'll be safe operating the project for a while, but eventually, you're going to have quite a bit of trouble coming up with the $40 million that will be coming due. Although you are not in danger of bankruptcy immediately, your bonds are now trading in the open market at a deep discount to par. This is raising your cost of capital and making it very difficult for you to borrow money to fund other projects that might be profitable and can help you with your cash flow so that you can stock up to make that big bond payment later. You would like to believe that prices are going to recover quickly, but then you realize that many other industries have been investing in projects just like this one, just like you did. And if you decided not to curtail production at lower prices, then others are probably making the same decision. This oversupply of oil is likely to be on the market for quite a while. So now we see a prime example of where optimism and hype can lead to big trouble. I've seen this happen over and over again in various areas, not just oil. Optimistic projections lead to commitments that are very difficult to undo when conditions change. I find that one of my most effective tools as a director in a large chemical company is to make judicious use of the word no. And just to share with you something funny, I'm actually starting to get the nickname Dr. No from my colleagues. But back to the point that I'm trying to make. High prices led to hype, and hype led to lots of investment. But there was something other than high prices that also led to overinvestment, and that was low interest rates. Remember I said that the cost of borrowing was 5%? Well, several years ago, the cost of borrowing was nearly double that. In our hypothetical example, the interest expense of borrowing was $2 million per year, or $20 per barrel. At a 10% corporate interest rate, the interest expense would have been twice that, or $40 per barrel. The net effect of this was to make capital investment a very attractive proposition at an oil price that was $20 below where it would have needed to be otherwise. Low interest rates will always lead to overinvestment, and more productive capacity than higher interest rates. This is what makes the 25-year-long downward trend in interest rates so dangerous. Falling rates lead to capital investment, lots of it. The capital investments, once made, are sunk costs. Unless bankruptcies are forced, then the investments will continue to be operated whether the demand is there or not. The excess capacity leads to lower prices than would otherwise be present if supply was correctly matched with demand. This will eventually lead to mass bankruptcies, currency failure, and eventual shortage of supply. But it takes quite a bit of time for it to materialize, and in the meantime, interest rates continue to be driven lower to try to spur on demand. But by the time the effects show up, it's far too late to act. The capital has been destroyed, and the reckoning needs to be made that the capital that has been priced so highly is not worth nearly what people think it's worth.